All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. So if you've been researching utilizing life insurance for real estate investing, I want you to know that you've come to the right place. So today we're going to be talking about policy loans. In the last video, I talked about the 3 key success factors for the double play. And number 2 on that list was accessing the cash value in a tax-advantaged manner. And what I had recommended was accessing the cash value using a cash value line of credit from a bank so that the interest is tax deductible on your real estate investing. In this video, I want to talk about the other policy loan options that you have. And the reason for that is because there's a time and place for everything. And I just want to go over that for you. So stay tuned after the intro and we'll dive right in. I'm Tom Rutkowski with Innovative Retirement Strategies, and I confess I'm a bit of a financial nerd, so things like compounding interest and interest rate arbitrage fascinate me. And I came up with the concept of the double play on my own many years ago, and it's so powerful that I wanted to share it with everybody. So the goal of this channel is to demystify life insurance and give you the tools that you need without ever talking to an agent to get the most efficiently designed policy possible to maximize your wealth accumulation through your use of the double play. I'm going to give you all the tools that you need to know to separate the facts and reality from the hype and BS that's out there. My target audience is the person who's researching life insurance and real estate investing and have questions. Lots of questions. Detailed questions. So I want to give you the answer that you're looking for so that you can feel comfortable that you made the right decision. That when you look back 20 years from now and you look at your portfolio balance, you know that you made the right decision. So be sure to like this video right now while you're down there, subscribe so that you're notified whenever I come out with new videos. All right, again, today we're talking about policy loans. In the last video, I talked about the 3 key success factors for the double play. And number 2 on that list was accessing the cash value in a tax-advantaged manner. And I specifically recommended using a cash value line of credit so that the interest on your loan is tax deductible and can offset some of the gains on your real estate investing. Today I want to talk about all the different policy loan options because there's a time and place for everything. All right, let's take care of some formalities first. First off, there is no rendering of advice, no tax advice, no financial advice. This content is purely educational. And secondly, the primary reason to purchase life insurance is for the death benefit protection. Any other benefit is purely ancillary. All right, and we're going to be talking about life insurance at a fairly detailed level. So if you don't have a good grasp of permanent life insurance or understand the difference between term and permanent life insurance, between whole life and indexed universal life, I've got a life insurance 101 tutorial. There's a video for it and a blog post, a white paper that you can download. So go down to the description and you can find the links to both of those. So my goal is to talk about the 3 main options that you have for policy loans from different companies and what the applications are for each of those. When is the best time to use a fixed loan, for example? When is the best time to use a variable loan? And index loans are only on indexed universal life policies, so that'll be unique to IULs, but fixed and variable loans are a function of both whole life and indexed universal life. So the thing that I want to start off first is to explain why we even have policy loans. What you see on screen right now is the statutes for Florida, my home state. And basically, if you can separate the legalese from what the real message is in there, which I've highlighted in the red box, insurance companies must make loans to their policy owners secured by the cash value of those policies. So it doesn't say that you're borrowing from the policy. It says that the insurance company must give you a loan of their money with your cash value serving as the collateral. And further at the bottom, it states that if the policy owner doesn't make the interest payments on the loan, the insurance company is to advance them the cash to pay themselves the interest, and they simply tack it on to the loan balance. So think about how cool a policy loan is. The insurance company has to give you a loan with your cash value as collateral. No applications, no underwriting. So long as you have the cash value in your policy, they have to give you a loan back to buy it. And you don't even have to make interest payments. So you can keep that money out as long as you want. I mean, that's the basis for how most life insurance retirement plans work. And in fact, if you want a link to the life insurance retirement plans, I'll put that down below so that you can see how this is utilized to generate tax-free retirement income. So the first loan option that we're going to be talking about is fixed loans. And while fixed interest may sound appealing, when you think of a mortgage, for example, you think of locking in a nice low rate for 30 years and you don't have to worry about interest rates changing. Well, in the life insurance world, things are a little bit differently. On an IUL, for example, when you take a fixed loan, they move the cash value that's securing that loan into their fixed interest crediting strategy. So what you end up with is a wash loan where the loan interest rate is exactly equal to the what the interest is being paid on the cash value is. And there's no opportunity for interest rate arbitrage, which is my favorite thing. And in fact, it gets even worse than that. All the insurance companies have different rules, but as a general rule, you're penalized for taking a fixed loan, in the early years of the policy. Meaning, if they charge you a 3.75% interest rate on the loan, they might only credit your cash value with 2.75. They give you a 1% penalty. So when you're talking about the double play, you don't want to use a fixed loan because there's no opportunity for arbitrage. And worse, you're being penalized at that. Now, in the whole life world, a policy might have just a fixed interest rate stated in the policy that never changes for the life of the policy. And that can be good or bad as well. But I've seen a lot of people who have old whole life policies with loans at 8%. And when the cash value or dividend is only a 6% or 4%, you can see that they're going backwards very quickly. So when would you want to use a fixed loan? So a fixed loan would be used in a life insurance retirement plan when 20, 30 years from now, where the economy is something like the economy was back in the late 70s and early 80s, where you had high inflation, high interest rates. And that's a time when you don't want to bank on having your cash value perform better than your loan interest rate. So anytime the interest rates get high enough that it makes more sense to just take a fixed interest rate over putting it into an interest crediting strategy tied to a market index, that's when you'd want to take a fixed loan. So if you think about a life insurance retirement plan where you are borrowing against your policy's cash value for retirement income, well, if interest rates were at double digits, like let's just say 10%, the thought of borrowing to fund your retirement when interest rates are 10% would be daunting. You'd think twice about that. But you also have to remember that the cash value would be growing at 10% as well. So even with those high interest rates, you have the security of knowing that your cash value is exactly offsetting the loan balance. So that's a time where I would use a fixed loan. So the next loan option is a variable loan. And a variable loan has a variable rate, as you would expect. But the beautiful thing here is that the cash value continues to stay in whatever interest crediting strategy that you selected, if you have an IUL. Other companies, whole life companies, offer variable loans as well. The loan interest rate is usually tied to the Moody's corporate bond yield, so it does fluctuate. But again, companies have different rules on how often they can change the interest rate on you. So the beauty of a variable loan is that it gives you the opportunity for interest rate arbitrage. Because your cash value continues to earn the dividends that it was already receiving in the case of a whole life, or the interest crediting in whatever interest crediting strategy you have, your cash value still earns that. And any loan that you take is just simply charged whatever the interest rate is that they define. And in fact, you can think of it as the two parts that the insurance company don't know about what the other one is doing. Your cash value is just there doing its thing, and some other part of the insurance company is just simply looking to see that you have the cash value to secure it, and then making a loan to you. And then keep in mind too that life insurance policy loans are an investment to the insurance company. They're out there investing in bonds and mortgages, anything with security and constant interest payments, right? So when they make a loan to you secured by the cash value that you have, they have a pretty good confidence level that that loan is going to be repaid. So they don't mind doing that. It's an investment from their perspective. People often ask, like, how can they pay me, 7% of my cash value when I'm taking a loan at 4? Again, you're not borrowing your own cash value, right? Your cash value is earning whatever the interest crediting strategy is going to pay. But the insurance company still has to deploy their assets, their general fund. And they have to select investments for that. And that policy loan is simply an investment that they make. So I hope that's clear. If you have questions, post them in the comments below. I'm always happy to engage in dialogue with everyone. So the only risk with a variable loan is the negative interest rate arbitrage. So when it comes to the double play, we don't care about negative interest rate arbitrage. If you're thinking about the double play and you're thinking about using a variable loan option for it, don't think about the arbitrage inside the policy. That's a big mistake. The arbitrage is on the outside of the policy. It's if you can get money at 4% and you can invest it at 10, that's business. That's an arbitrage that you're creating with that money. And you're going to make that money whether your cash value went up or it didn't go up. Again, this is an IUL, not a whole life. But I want you to understand that just because the cash value didn't go up one year, it's going to go up in subsequent years, right? The market is going to go up, the market's going to go down, and there are going to be years when you earn some interest crediting and when you don't. In fact, if you look back at the history, you find that most of the time it's about 1-0 for every 2 years of market up. So don't focus on arbitrage inside the policy, focus on arbitrage outside the policy. So zeros are bad when you retire. When you're taking income via policy loans against your policy's cash value when you retire, you're not paying back the interest on those loans. So that's the time that a zero becomes a very bad thing, because you have the risk of borrowing money from the insurance company to pay the interest on the loan, yet your cash value didn't go up to offset it. So you need to have that income or cash value going up to offset the value of the loans. So I don't want to spend a whole lot of time going over how you deal with that risk when you retire. I covered all of it in the life insurance retirement plan video, and that's also available on my website as a blog post. So be sure to check out either one of those, because there are many different ways that either the insurance company has thought of a way to hedge against that risk, or things that you can do to hedge against that risk. So don't let the negative interest rate arbitrage scare you away from using a life insurance retirement plan. So when should you use a variable loan? So as I stated in the video last week, the 3 key success factors for the double play, you want to access the cash value in the most tax advantaged manner, meaning you want to take a cash value line of credit. So I'm giving this video this week for the reason that there is a time and place for everything, and there are places where you would want to use a variable policy loan. And one example would be if you're buying some real estate and you're using leverage, meaning you're going out to a bank and getting a loan for, let's just say, 80% of the purchase price of that home. If you used a policy loan to pay the other 20% of that, you have to disclose the source of funds to the lender, and the lender may not want to know that you're getting the funds from a cash value line of credit. But again, I'm not an expert on this and not a tax advisor, but most of the time, mortgage companies are willing to accept the cash value in a life insurance policy as collateral. So you can use the policy loan to make the down payment and just pay the interest to the insurance company. It may not be tax deductible, or it may if you talk to an accountant and the accountant is comfortable with it. I'm not. I use a cash value line of credit. But I have had other people say that as long as you trace the funds from the policy loan to your investment, that you can deduct it. So I just want to get that out there as well. But think about that as an opportunity though. If you're borrowing money from the bank for 80% of the purchase price, and you're using a policy loan to come up with the other 20%, you've bought that property with 100% of other people's money. So any return that you get on that is an infinite rate of return because you have no cash in the deal yourself. And that's a beautiful thing. Variable loans are also wonderful for life insurance retirement plans. So if you're borrowing against your policy's cash value to retire, to take retirement income, it's nice to know that the cash value balance is actually growing at a faster rate than your loan balance is accruing interest. And hopefully everybody can kind of see that. I didn't prepare a chart for that, but if your cash value is growing at 6%, 6.5%, and you're borrowing money at 5%, there's a 1% spread that your cash value is actually greater than the loan balance. And what that allows you to do is take more retirement income as a result. So you'd be hard pressed to find any whole life that can show as much retirement income as an index universal life can. Just because there's not the opportunity for arbitrage in a whole life like you have in an index universal life. Because the index universal life is going to capture a premium over the return that a whole life can get on its general fund. So the next option is more of a hybrid. An index loan option is only on index universal life, but with an index loan option, you get a fixed or at least capped interest rate on your loans, meaning that the interest rate that is charged to you will never go above a certain mark. And they accomplish that by moving your cash value from the interest crediting strategies that you selected. But unlike a fixed loan, they're not moving it into the fixed interest crediting strategy. So they've created a indexed loan account that they manage, and they has a separate cap from the other accounts. So you go into retirement knowing that your interest rates will never rise above, let's just say, 5%. And it gives you the opportunity to know that you will have at least some opportunity for arbitrage because your cash value is still being hedged and earning hopefully a superior rate of return. I say hopefully only because year-to-year variations are to be expected. I hope at this point, after all these videos, that's a given. But because you're able to capture that equity premium, the IUL return over the long run will be superior to that of a whole life. So that's where I'm going with that. So when would you use an index loan option? So like today, for example, if you're doing the double play and you have a choice of using a loan that's capped at 5%, or let's just say it's even fixed at 5%, or a variable loan that's at 4%, or cash value line of credit, even better, right, at 4%. The first choice for the double play would be the cash value line of credit. But if you're doing the double play and making a down payment with it, or you don't want to use that cash value line of credit, then the first choice would be using a variable loan if the interest rate is below the cap, right? Now, if interest rates go up, and now all of a sudden the variable loan interest rate is higher than the indexed loan interest rate, then you would use the index loan. So hopefully that's common sense. But the other opportunity for the index is when you retire. Just knowing that the interest rate on your loans will never go above a certain point. There will hopefully always be that opportunity for some interest rate arbitrage. And lastly, I thought I'd throw the cash value line of credit into the mix as well. So I did talk about that in previous videos, but I thought I'd just put it out here again, that it's the fourth way that you can access the policy's cash value by simply going out to your bank, or not every bank does these, but there are banks who will give you a line of credit secured by the cash value of your policy. And basically all you do is give them an assignment against your policy and they loan you money. And one reason that I like the line of credit, especially for the double play, is it really cements in your head the idea that you're not borrowing your own money. You're borrowing the insurance companies in the case of a policy loan, or the bank's money in the case of a cash value line of credit. But I think it's important for everybody to get it in their head that they're not using their own money, that you are getting a loan, and that there is a risk to that, right? If you're using other people's money to make a business, businesses aren't always profitable. Real estate investments are not always profitable. So there is risk. And what the cash value line of credit does is you have to apply for it, you have to make monthly payments on it, and you will do much better due diligence on your deals when you know that you have to come up with enough money to pay the interest on your loans. So I find that, at least for me and for the clients that I work with, I prefer them to use the cash value line of credit for that reason, just because it really cements in your head that you are not borrowing your own money. You're borrowing the bank's money. Some of the cons with a cash value line of credit, of course, are you have to apply for it, so there's paperwork, you have to have credit, and you have to make payments on it. On a life insurance policy loan, you don't have to make payments. Some of the applications for a cash value line of credit. First and foremost is the double play. You just want to make sure that your interest is tax deductible on the money the policy's cash value that you access. Other than that, I really can't think of any other opportunities where I would use a cash value line of credit other than a policy loan. All right, and just some other things that I thought I'd throw in here for you about policy loans. One is you can, again, rules are different between insurance companies, but for the most part, you can switch between loan types at least once per year. So you're not locked into a fixed loan. You're not locked into a variable loan. You can switch back and forth, whichever one happens to be in your favor. Secondly, the advantage of a policy loan is that there's no application, no interest payments required. But again, if you're using it for the double play, make sure that you pay the interest, because that's a business deduction, or at least you could get a business deduction. But one way or the other, you want to treat it as an investment, treat it as your cost of business, and make those payments. The last thing you want to do is have a compounding investment, but having a compounding loan balance offsetting it. All you're really capturing is the sliver. When you pay the interest, you're paying a set monthly amount every single month, yet your investment is growing at a compounding rate, right? So you're creating this arbitrage between simple interest that you're paying every month on your loan and compounding interest, which is the asset that you're investing. So always keep that in mind. Pay the interest. Now, the only exception to that is when you retire, because there you have no choice. You're taking income from the policy, and you don't want to just give it back in terms of interest, because every single year you're going to be paying interest on all the money that you borrowed in all the years before, and all the interest that you financed in the years before. So it gets to be a very big number, but it's always secured by the cash value, as long as you don't take too much, right? Don't do that. All right, so the previous point brings up a new point that I want to make sure I address, and that is that the loan plus any interest that you finance in the case of a life insurance retirement plan must be collateralized by the cash value in the policy. So the thing you have to be cognizant of is the insurance company is also dipping their hands into the policy's cash value to take out their fees. Now, in the later years of the policy, and assuming it's designed right, the fees are very low, something like 0.25% per year. But for those of you doing the double play, you have to be cognizant of the fact that in the first years, the insurance company fees are much more substantial. And if you borrowed all the way to the max and you don't make a premium payment the next year, you could find yourself in a position where the insurance company took out, a couple $1,000s to pay the fees, and now you don't have enough cash value to secure your loan. That can cause a policy lapse. Which brings us to the next bullet point, which is most life insurance policies have an overloan protection rider. And what the overloan protection rider does is, in exactly that situation, it would keep the policy from lapsing, as the name would imply. So it basically just shuts down your ability to take any more money. And in fact, it looks like, just like an IRA or 401k, where you spent your last dollar of savings and you have no more. So that's what the overloan protection rider does. All right, so wrapping up, the key message that I wanted to get across in this video was that there's a time and place for everything. So while the policy loans are not the optimal way to access your policy's cash value for the double play, there are other applications where you would want to use a fixed loan or a variable loan or an index loan instead of a cash value line of credit. All right, if you're hungry for more information and you don't want to talk to a life insurance agent, I highly recommend that you go out to Facebook and join the Double Play group. And that is a community of my clients and many people who are just interested in learning about the double play and leveraging high overfunded, maximum overfunded life insurance policies to invest in real estate. So the link is in the description below. Be sure to go there, check that out. There's also my YouTube channel, so be sure to subscribe and check out the channel itself and all the old videos. There's a ton of great information there, starting from the basics of life insurance all the way up through the use of the double play and all the important factors that you need to know about the double play to make the most of it. As I've stressed in the last video, there's doing it and then there's doing it right? So, and lastly, there's my website. My website is a no fluff zone. There is a wealth of knowledge on there. Blog posts, web pages, there's just a ton of content. Some of the blog posts mirror the content that's in these videos, but there's a lot of other original content that hasn't made it to these videos yet. So be sure to check that out, and thank you for watching, and I'll see you in the next video.